Most people completely misunderstand how inflation actually works in reality. It is not just a random accident or a broken economy. Inflation creates one of the biggest wealth transfers in modern finance. It constantly moves wealth from people holding cash to people owning assets. If you understand the system, you can actually protect your wealth. You have probably been told that a perfect economy means low prices, but central banks actively target 2% inflation every single year. They believe this small amount of pain is a necessary evil. It forces you to spend your money instead of endlessly hoarding it. When everyone is forced to spend, the economy actually keeps moving forward, but this system naturally creates massive financial winners and massive losers. The losers are the people who hold all their wealth in cash. The winners are those who buy productive assets and use strategic debt. Many wealthy investors understand this dynamic perfectly and position themselves accordingly. They do not necessarily love inflation, but they know how to navigate it. Stop letting the financial system slowly drain your purchasing power every year. Start learning how to position your portfolio exactly like the wealthy do. To truly understand this, you have to look at how money changed. For a large part of modern history, currencies were tied to physical gold. This meant governments were somewhat limited in how much money they printed. They could not just create endless dollars without the gold to back it. Because the money supply was limited, prices for goods were remarkably stable. During the late 19th century, periods of deflation actually caused prices to fall. As industrial technology improved rapidly, things became cheaper and easier to produce. But a system with falling prices can be very dangerous for an economy. When consumers expect prices to drop tomorrow, they delay their purchases today. This sudden drop in spending causes businesses to lose significant profit margins. When businesses lose their profit margins, they are forced to lay off workers. And massive layoffs can quickly trigger a dangerous deflationary economic spiral. To prevent this scenario, governments eventually transitioned entirely away from the gold standard. This transition gave central banks the ultimate flexibility to manage the economy. They can now inject fresh money into the financial system during major crises. But printing more money inevitably dilutes the value of every existing dollar. When you hold cash in a bank account, it slowly evaporates over time. The real purchasing power of that money drops steadily year after year. This is exactly why wealthy families rarely keep their net worth in cash. They understand that cash is meant for immediate transactions, not long-term storage. Let me explain a powerful financial strategy used by real estate investors. It involves using fixed-rate debt during periods of high economic inflation. Imagine you borrow $1 million to buy a large apartment building. Your interest rate is firmly locked in at 5% for several decades. Suddenly, inflation spikes aggressively, and the cost of everything goes up. Most people immediately panic because their daily grocery bills are skyrocketing. But the real estate investor is quietly watching their debt burden shrink. The $1 million they owe is now worth much less in real terms. They're paying back the bank with cheaper, heavily inflated dollars. At the exact same time, the underlying value of their building often rises. They might also be able to increase their rent to match the inflation. Inflation is essentially helping them pay off their massive financial debt. However, you must understand that this is absolutely not a risk-free strategy. Financial leverage is a dangerous double-edged sword that can completely destroy you. If you lose your income or your tenants simply stop paying their rent, massive debt will absolutely bankrupt you long before inflation can ever erode it. This brings us to a major ongoing debate in the personal finance world. Many famous financial gurus confidently tell you that all debt is inherently evil. They strongly advise you to pay off your mortgage as fast as possible. For people who struggle with spending habits, this is genuinely fantastic advice. Being completely debt-free provides incredible peace of mind and psychological safety. But mathematically speaking, rushing to pay off a low-interest mortgage can cost you. Imagine your 30-year mortgage is locked in at a very low 3% rate, and you aggressively pay it off instead of investing that extra money. You are completely missing out on the historical returns of the stock market. A broad stock market index fund historically returns around 8 to 10% nominally. By aggressively paying off cheap debt, you are giving up that potential spread. You are trading mathematical optimization for absolute psychological comfort and security. There is absolutely no wrong answer, but you must clearly understand the math. You have to weigh your personal risk tolerance against the potential financial gains. Stop blindly following the exact financial advice your grandparents confidently gave you. They grew up in a completely different economic and banking reality than you. Decades ago, basic savings accounts actually paid you a decent real return. You could safely put money in the local bank and reliably outpace inflation. But in recent years, traditional savings accounts have paid practically nothing at all. If inflation is at 4%, and your bank pays you 1%, by leaving your money in that account, you are literally guaranteeing a loss. You are slowly bleeding your hard-earned purchasing power every single day. Thankfully, high-yield savings accounts have made a very strong comeback recently. But over a long time horizon, uninvested cash is still a melting ice cube. The bank takes your deposits and immediately loans them out to other investors. Those investors buy real estate and profitable businesses that generally appreciate in value. The bank profits heavily off the massive spread between your money and their loans. If you want to survive the modern economy, you must eventually become an owner. Buy high-quality assets that have the strong potential to grow over time. So what are the hard assets you should actually be looking at buying? Real estate is a classic inflation hedge because of the fixed-rate debt factor. But obviously, not everyone can afford to buy an apartment complex tomorrow morning. That is completely fine, because you have many other powerful options available today. High-quality stocks and broad index funds represent direct ownership in real businesses. When global inflation goes up, profitable businesses often raise their prices to match it. If they can successfully pass costs to consumers, their revenue naturally increases. This fundamental dynamic generally helps drive their stock prices higher over the long term. You are essentially buying a small slice of the inflation engine itself. You can also look into historically significant precious metals like gold and silver. Gold has historically acted as a reliable long-term store of value during crises. Some modern investors also strongly view Bitcoin as protection against continuous monetary debasement, though its price remains highly volatile and often behaves more like a tech stock. The specific asset you choose matters much less than your overall financial positioning. You need to stop holding excessive amounts of idle, uninvested cash right now. Keep enough for a solid emergency fund and strategically invest the rest. Economic uncertainty creates massive opportunities for people who clearly understand the system. Stop letting inflation quietly steal your hard-earned wealth every single year. Position your portfolio so that rising prices actually work in your favor. Position your portfolio so that rising prices actually work in your favor.